7 stocks I'm buying now, September 2023 edition. Welcome in, folks, to my favorite video I do on this channel each and every month. We're about to get into 6 stocks that I'm planning on buying in the upcoming month, and then 1 stock that I'm planning on buying put options on as a hedge for my portfolio overall. I'm going to take you through my whole thought process in regards to these in today's video. So I appreciate every single person for taking the time to enjoy this video here with me today. I'm looking very forward to record this one. Always the most, fun video for me to record each and every month, where I go through a bunch of different companies and why I'm excited to buy these companies. So I appreciate y'all taking the time to enjoy this. If you enjoy me putting out these videos, you enjoy my content in general, then consider supporting my content on Patreon. That's going to be pinned comment down there. You also get access to see the stocks I'm buying and selling every week through my Fidelity account. That's in the Patreon portfolio. Plus you get access to a Discord chat as well. And I even have a tier that has a course attached to it. So I appreciate everybody watching this one here today. And let's go ahead and get straight into this, folks. Winning Resorts is the first of these 7 stocks. Now, Wynn Resorts, I always have called it Winning Resorts over the years, but to be quite frank, over the last many years, it's been losing resorts. And the reason being is obviously the government shut down let's just call it their locations, right? The Las Vegas properties were closed for a while, then those opened back up, but then the Macau location, Macau in general, which is a huge region for Wynn Resorts, they kind of opened it as far as the Chinese government, and then they shut it down, then they limited it. It was a mess for 3 years. Basically, from the start of 2020 all the way through the beginning of 2023, it was a mess. Things have opened back up there. It's about to be winning resorts once again, okay? From losing resorts to winning resorts again. Now, if you don't know Wynn and Encore, they operate the premium properties on the Las Vegas Strip. They operate Wynn and Encore. These are the highest end properties out there, the most well-run properties on the Strip by far and away. And these are sorts of properties that really attract the VIPs, big money, the higher end of the mass, and the type of people that go to Wynn and Encore. They spend a lot on the gaming floor, and these folks also spend a lot on the restaurants, the retail. You're going to see stores in there like Louis Vuitton, Rolex, all the highest end brands in the world. They all want to be associated with Wynn and Encore because that's it's the creme de la creme customer base out there. They also operate a property, Encore Boston Harbor, right outside Boston. And this is an interesting property because they basically sold the building and the land to basically like a real estate investment trust, and so they kind of have a sale leaseback situation going on. But Wynn actually operates the property inside, obviously the hotel, obviously the gaming floor and the restaurants and all those sorts of things. So that's an interesting kind of arrangement there. They could do something like that with Las Vegas if they want to long term. We'll see. They also operate these 2 properties on the old part of the Macau area, Wynn and Encore. These were their 2 first properties in the Macau region. They've historically been extremely profitable properties for them, except for the last 3 years when Macau was shut down. And then they also operate the big dog, Wynn Palace, which is, the last super massive project under the Steve Wynn kind of era that he opened up. And, unfortunately, this property was just starting to ramp in a major way, and then the shutdowns came, obviously, in 2020. So, we still haven't even really got to see yet how successful Wynn Palace can really be over the coming years. Now, on top of that, they also own one of the rare undeveloped pieces of land on the Las Vegas Strip. This piece of land is directly across from the Wynn in the Encore. It's one of the very few undeveloped pieces of land on the Strip that's on a great piece of strip. I mean, you got Treasure Island right over here. You got Palazzo and Venetian right here. You got this is over here is the mall, which is the best mall, fashion show mall in Las Vegas. So I mean, this property is the creme de la creme. So I don't know if Wynn's just going to sit on the land and sell it to somebody, or if they're going to eventually develop something on it. But that's a pretty interesting piece of real estate they own. And then on top of that, they're building a property right now in the Middle East, which is a very extraordinary opportunity. That's, can't get excited about that anytime soon. And they're partnering with some folks in regards to that deal. That's going to be more of a 2026, 2027 and beyond story in terms of that Middle East property. Now, in terms of Wynn Resorts, this is a company that was losing resorts for a while there, right? While you had the Macau shutdowns and everything going on, and they kept missing earnings. Wynn historically was a company that usually was known for hitting earnings, beating earnings, right? Well, very recently, they're starting, now that Macau's starting to open back up again, they're starting to beat their earnings again. They beat it, 2 quarters ago. They beat it this past quarter as well. And if you look at analyst estimates for this company, they have them doing about 324 current year for the company. 2024, they have been doing 471. That puts it at about a 30 forward P for this year's numbers in 21. But keep in mind, I have a pretty high confidence level that they're going to crush those numbers. We got Vegas F1 race coming in November. That's the biggest thing pretty much to happen in Vegas ever. I mean, the amount of money that's going to be attracted F1 weekend is ridiculous. I can't even explain that. Then you have the Super Bowl coming to Vegas 2 months later. Like, it doesn't get better for Vegas and for the Vegas properties. Macau's like getting back to big numbers that we're going to go through in just a moment. So I'm pretty confident that Wynn's going to come in and crush. I mean, absolutely obliterate some numbers. Now, in terms of Macau GGR, gross gaming revenue up 3% on July, new high since the Rona era, right? Macau's August casino gross gaming revenue rose 3.3% month over month to, let's call it $2.13 billion. Now, this is extraordinary for Wynn and extraordinary, obviously, for all the operators in Macau, because all these folks have been losing a fortune in Macau for basically the past 3 years, and now these guys are finally getting back to profitability in Macau again, and it's going to boost their businesses in an epic way. In the August tally was up 686% from August 2022, which goes to show you the sort of growth that's going on in Macau right now with it finally being opened back up. Now, keep in mind, the growth is kind of accelerating here because if you look at this, the latest data took Macau's gross gaming revenue 8 months to August 31st, and that was up about almost 300%. But the recent numbers are up almost 700%, right, on a year-over-year basis, which kind of goes to show you that in terms of Macau, it's really accelerating. It's accelerating rapidly. And what that's going to end up producing for Wynn for profitability is going to be enormous for this company for obviously many years to go in the future, but certainly right now. Now, in terms of the dividend for the stock, it's only 1% yield, but keep in mind, now that Macau is going to likely get back to huge profitability again, don't be surprised if that dividend gets upped quite substantially over the next several years and Wynn starts to become a major dividend stock once again. So, in regards to Wynn Resorts, absolutely love this one, and it's one of those stocks I can feel comfortable. All the stocks I'm listing off here today in this video, all these stocks are stocks that I feel comfortable investing in during a recession, during a good economy, and a so-so economy. That's all these companies we're about to go through here today. Wynn Resorts is one of those companies. It doesn't matter. A recession, a great economy, an okay economy, regardless of what's going on out there, I feel comfortable investing in a company like Wynn Resorts. They cater to the highest end of folks that like to travel around the world. And that's just a very attractive market. And just keep in mind, rich people are always rich, okay? Alrighty, number 2 of these 7 stocks up here is PayPal. So, PayPal, this is obviously my favorite stock I'm buying right now. I've been buying these shares very aggressively. I'm going to continue to buy these shares very aggressively all the way to the end of this year, essentially, okay? So, PayPal. A lot of things I'm excited about here with this one. They own PayPal and they own Venmo. If you look at the iOS leaderboard in the United States of America on any given day, pretty much, Venmo and PayPal are the number 2 and number 3 most popular apps every single day. Usually the only one that outdoes them is what's called Cash App, okay? Now, if that wasn't enough, those successful businesses obviously own PayPal and Venmo. They also own Braintree, which is, let's just kind of think of it as the back end of a lot of e-commerce businesses, of a lot of apps and websites in general. And the thing that makes Braintree so special is you as a business, you as an e-commerce company, whatever, you're going to be more successful the more payment options you offer. If you can offer credit cards, debit cards, if you can offer Apple Pay, Google Pay, PayPal, Venmo, and many other services, you're just going to be much more successful than if you don't. Like, it's been statistically proven by a lot of companies over time, like the more options you offer, like the better off you're going to be. Because and especially nowadays, because not everybody likes to pay the same way. Somebody might use PayPal and Venmo that doesn't use Apple Pay. Somebody might use Apple Pay that doesn't use PayPal and Venmo. Somebody might use PayPal that doesn't use a debit card or credit card. Like, there's all these different phenomenons that go on out there. And so you've got to have all these different options at your disposal, okay? And they also own this business that doesn't get talked about that much called Honey, which is, think of it kind of as like coupons, promo codes, deals, things like that you can easily integrate into the PayPal app, PayPal website, or other places as well. So that's an intriguing, just quiet business no one really talks about, because obviously when you own PayPal and Venmo, like everybody's going to talk about PayPal and Venmo and kind of forget about Braintree, forget about Honey or anything else you really got going on out there. Now, in regards to PayPal, this is one of the most consistent growth companies over time, this is their revenue growth over the years. I mean, it doesn't really get more consistent than that. It's absolutely beautiful in terms of their revenue growth over the years. Now, where things get shakier is net income growth, because the net income growth has been, up and down over the years. For a while there, they had it consistent. Obviously, from 2013 to 2014, net income dropped in a massive way while revenue was going up. And, it was kind of on an uptrend. Then it went, obviously, insane kind of during Rona. Then we kind of flatlined. It went down. A lot of that has to do with some one-time expenses and a bunch of other messy stuff. So nonetheless, PayPal's been going through a messy time when it comes to their bottom line, and that's certainly weighed on the stock price in a significant manner. Now, with that being said, recently, they're getting their bottom line back together in a very healthy way. If you look at their latest quarterly numbers they just reported, their EPS was right in line with what analysts were expected, and as far as on a GAAP basis, generally accepted accounting principles, they actually had a very nice beat as far as the EPS there, okay? They also beat on revenue as well. So this is what PayPal needs to get back to, is a company that's known for beating numbers, not missing numbers, right? A company that's consistently grown net income, the shareholders will return in PayPal over time, okay? As long as they can put up those numbers. Now, in terms of EPS growth, this is what analysts have on average. Year-over-year growth, about 20% expected for this year, about 14 to 15% expected next year, 2025, 12.5%. That puts the company at 12 times this year's numbers and 11 times next year's numbers. Now, for a company that's growing, like PayPal's growing, like that's stealing money, like in my opinion, right? If this was a company that, their revenues are just going to go down and down and down, I could say, okay, yeah, this might not be a good deal, right? But for a company that's a growth company, here's what analyst expectations are. And I have somewhat similar numbers as analysts have. They have them growing about 8% this year, 9% next year, and 9.5% the next year. For a company that's growing top line like that and likely going to grow the EPS like they're going to grow it, I think the risk reward is pretty darn attractive at this valuation. So that's why I'm buying every share in sight in regards to this one. Now, we get a new CEO coming in, okay? Alex Chriss. Okay. Now, he's going to start here actually this month as far as on the job, right? He's going to be PayPal's new president and CEO. He's got two big roles now as the president and the CEO of this company. This is big time for Alex Chriss. He comes over from Intuit. I've looked more into him and I like the move. Obviously, we need to see it play out. We need to make sure he is the right guy. You can't get too excited about these new CEOs that come in at a company, right? Because at the end of the day, you never know if they're going to pan out. Sometimes they don't. Alex Chriss has a pretty good pedigree coming from Intuit. He was a very high-level person at Intuit over the years. And Intuit, one of the most beloved stocks in the entire stock market. Intuit's absolutely unbelievable. This stock, if you go back kind of 2010, 2011, this is like a $40 or $50 stock. Today it's a $500+ stock. So the stock's over 10x in just over 10 years. Now, do I expect him to over 10x PayPal stock over the next 10 years? No. But if PayPal can be a 2x, 3x, 4x returner, I will be a very happy shareholder. And considering how low of a risk I believe I'm taking in PayPal because of the valuation it's currently trading at, I'll gladly take the risk reward on this one. And so, yeah, really excited about PayPal in the future of this one, and that's why it's the number 2 of these 7 stocks. Number 3 of these 7 stocks up here that I am buying in September 2023 is Amazon stock. So, Amazon stock actually has had a bad past 5 years. Stock's only up 36%. For Amazon, that's a rough 5-year span there, okay? Let's just put it that way. Now, the way you need to think about Amazon's business model, and the way I think about Amazon's business model is this, okay? Because most people, when they think about Amazon stock, the first place their mind goes is like, oh, cool, I'm buying Amazon, the e-commerce business. And they think about all the stuff they order on Amazon, and they think about all those trucks driving around their neighborhoods. All fine, man, all cool stuff. But that's not where your mind really needs to go in regards to Amazon. The first place your mind needs to go is Amazon Web Services, okay? Amazon Web Services, think of it as a backbone of companies. Think about it as almost like the backbone of the internet now at this point in time, okay? Amazon Web Services, the big cloud giant itself. This is where the big profits come from for Amazon overall. I do believe the e-commerce business will build out profitability quite substantially over this next 5 to 10 years, but if you look over the years, it's really, how Amazon's really making their money is really from AWS, okay? Now, with that being said, after you think about AWS and how big that can be 5 or 10 years out, then you need to consider the e-commerce business, right? Then inside that, you need to consider Amazon Prime, because Amazon Prime, one of the biggest paid, if not the biggest paid membership service in the world for something like that, right? Absolutely incredible how many people are signed up for Amazon Prime, and I'm sure the numbers are just going to continue to grow over the years, and they'll be able to command higher and higher price points, as we've seen recently with them going up on price, right? At the end of the day, like once you sign up for Amazon Prime, I mean, I've been signed up for Amazon Prime for years, and I can't even consider, even if they were to go up $30 a month, I'm not canceling Amazon Prime. Come on, man, okay? Amazon infrastructure is something they've built out over the last 15, 20 years that's way underrated with the company. You can't duplicate that unless you have, so much money to spend. It's ridiculous. Their planes, their trucks, all over the place, their distribution network, their facilities, their robots, the logistics side. I mean, you can't duplicate that unless you have just so much money and know-how. I don't even know who could. The one company that seemed like they might try to challenge Amazon there was Shopify. And even Shopify got into that infrastructure side, and they realized, oh, hell no, this is too much, okay? So Amazon now has this super unfair advantage of their infrastructure that's just, in my opinion, one of the most underrated business aspects of any big tech company in the world, okay? Then from there, you need to consider their advertising business that has built out into a giant in the advertising space. Now, when you think about advertising, you really think about Google, Meta, which are the ones you've always thought about, and right under them, now you're starting to think about Amazon. Their advertising business has become a giant, okay? And I'm sure it has a long runway of growth ahead of it, and that's a straight profit. We know advertising brings in straight profits. Look at Google, look at Meta. That's a really exciting opportunity for Amazon, okay? Then from there, you need to consider the fact that they own businesses like Whole Foods and Twitch and others, okay? And so there's so much going on at Amazon. There's so many giant businesses they really own that are just game changers that it's a very exciting opportunity. And obviously, Andy Jassy reminds me of just like Jeff Bezos 2.0. Even some of their, oh gosh, the laugh is the one thing Jassy doesn't have that Bezos has, and obviously Bezos just has a little more stage presence. But even their tonality, even the way they speak between Jassy and Bezos, it reminds me so much of each other. It's unbelievable. And Andy Jassy was a man who really oversaw Amazon Web Services growth over time. He's done a phenomenal job leading Amazon since obviously Jeff Bezos stepped away. Now, in terms of EPS side, okay. And the company looks like it's trading rich. Based upon 2024 numbers from analysts, the company looks like it's rich, right? It trades at a 45 PE. Keep in mind, if you're going to grow EPS 40% or so, and you're expected to grow that over the next few years, that's not a high PE at all, right? If you're a company that's going to grow your EPS 3%, that's a very high PE. If you're growing your EPS 40%, that's not a high forward PE. And we do know, Amazon historically has been known as a company that beats their earnings per share estimates. And so if they can come in with some very nice beats that I believe they'll come in with over this next year, I mean, that's a pretty extraordinary opportunity there, right? Now, keep in mind, on the revenue side, this company has growth for days, obviously, right? And keep in mind, in terms of analysts, they actually have the company growing way under what they have historically grown. Now, usually Amazon's a company you can think about growing 15 to 25%. Obviously, analysts have gone much more conservative with about 10% growth. So we'll see if that holds up, right? But overall, they should cross over $600 billion of revenue in 24, over $700 billion of revenue in 25, and it's kind of a toss-up between 28 and 29 when they cross $1 trillion in actual revenue. That's an incredible number to just wrap your head around. $1 trillion in revenue, crazy. That's where this company's headed, right? Now, in terms of myself, this is my Amazon base case, okay? I have been averaging 12% revenue growth over the next several years, which I think is, not too crazy. I think that's pretty conservative. I've been doing about 18% net income growth on average for the company over the coming years. Keep in mind that number is probably low based upon kind of what analysts are expecting here of these kind of 39%, 42%, 27% numbers. So I might have gone a little conservative there with my net income growth, and that's fine. Now, the company should be able to command in 27 a forward PE or a PE of somewhere that's called 30 to 40. That puts it at about 1.7 trillion to about $2.3 trillion market cap. And that's with a net income margin of only 6%, 6.5%, okay, for my base case. So given what I think this company's doing, the base case around it, yeah, I'm willing to take let's just call it the risk-reward profile of Amazon. And this is another one of those businesses that I can feel comfortable buying Amazon in any economy. If the market's crashing, I can feel comfortable putting money in Amazon. If the market's skyrocketing, I can feel comfortable having money in Amazon. If things are just so-so, I can feel comfortable having money in Amazon. It really doesn't matter. Anyway, I feel comfortable having money in Amazon with the management team there, the business model they had there, the pedigree. I mean, it's phenomenal. So that's Amazon, otherwise known as AmazingZon. All right, next one up here. Number 4 of these 7 stocks up here that I'm buying September 2023 is Cheesecake Factory. So cake is a ticker symbol on this one. Cake, a crazy past 5 years, okay? And I did a whole kind of case study recently on Cheesecake Factory over 5-year spans, and you're going to find that Cheesecake Factory is one of the most cyclical stocks in the world in terms of it has these horrible 5-year periods followed by an amazing 5-year period, followed by a horrible 5-year period, followed by an amazing 5-year period. It's incredible, okay? But nonetheless, the last 5 years have been bad for Cheesecake stock price. Hasn't been bad for necessarily the business outside of 2020 when the shutdowns and everything were going on, but their stock price has been in a bad place for the past 5 years. Now, when you think about Cheesecake Factory, remember they own their restaurant, right? The Cheesecake Factory, the big dog, right? That they're always building more locations around, and obviously try to go to those places on a Friday, Saturday night and try to get a seat. Good luck without waiting for an hour or two, okay? Now, they also own this concept, which I think has incredible potential. North Italia. I mean, these locations, if you think Cheesecake Factory is packed, North Italia is even more packed from what I've always gone to. I mean, some of these North Italia are so busy you can't even get into them. I mean, I called one night when I was in Arizona. This is like probably, 2 months ago now at this point in time. They couldn't even get me in that night. I was like, there's no time slot open the entire night? Nope. Couldn't even get in. If you want to go to the one in Summerlin, I mean, usually you're looking at a huge wait time on almost every single night, but certainly on the weekends. So North Italia has a great chance of success as far as being a massive, let's call it, restaurant chain around the United States of America. Then they also own Fox Restaurant Concepts, which they own a bunch of different interesting concepts. If you're ever in Arizona, you can try out a lot of these concepts that they own. They own a lot of them. I've been to many of them, and they're all really, really good, and they're very well run, okay? They got that DNA, but it's really about testing to see, what's the next North Italia? What's the next Cheesecake Factory, right? What's that next huge potential concept here? Now, in terms of the numbers, right? Company trades, in terms of 2024 numbers, at a forward P of less than 10. Yeah, I'll take that. I'll take that. For Cheesecake Factory, I'll gladly take that. Obviously not the most exciting revenue growth story. 5 to 7% is what's expected over the next few years on average per year by analysts. That's fine with me. At a forward P of under 10 on this one. And the fact that think about what these restaurant chains had to go through. I mean, they had to go through all their restaurants being shut down back in 2020, which was crazy to think about. Whoever can see, you always think about recessions and, maybe we're not as busy. You always think about that. You never think about, our restaurant's going to be closed, forced to be closed, and then when we open back up, we're going to be forced to, have 50% capacity. You never even conceive of that, and that's what happened, right? That's literally the worst case scenario. And then they went through the second worst case scenario after that, which was super high inflation, where all the stuff that goes into making all the products, all the food inflation went crazy in 2022, right? And, some of that has subsided recently, which is good. Wage inflation all hit while you had very low unemployment, which obviously isn't the best thing in the world when you're in the restaurant industry. All those things kind of coming together, that's how the stock has had such a tough 5 years. And I think a lot of that stuff is going away now at this point in time, so it should have a much better next 5 years than it has over the last 5 years. Now, in terms of dividend, while I wait for the stock to do its thing, I get to make a nice 3% dividend yield on this one. Now, payout ratio says 53%, but keep in mind the company's expected, let's call it $3 of EPS next year, somewhere around there roughly. Well, if the payout's one, a little over $1, I mean, then we're at a 34% payout ratio, 35% payout ratio, or something like that, based upon next year's numbers. So, yeah, really like this one overall, and another one of those stocks that doesn't matter what happens. I feel comfortable. Good economy, I can feel fine buying Cheesecake Factory. Bad economy, same thing. It doesn't matter. This is one of those that I'll buy the dip regardless, okay? Next one up here, number 5 of these 7 stocks is Target, TGT on this one. I think we all know Target. I hope I don't need to explain this one. I mean, if you live certainly in the United States of America, I think you're well aware of Target, okay? Over the past 5 years, been a decent stock. It hasn't been an amazing stock, but it's been decent. But in regards to Target, pretty simple one. So Target used to be the most well-run retailer in all the United States of America, and they had that title for a while until Ulta took it away from them. But this company used to be a company that quarter in and quarter out, you knew they were going to come in with their numbers and they were going to probably beat EPS, and they're probably going to beat EPS nice. And if you look at this company over time, I mean, the EPS beats were just incredible. Target just knocking out of the ballpark. And then something happened. And in 2022, right, which says fiscal year 2023, but remember, this is like actual 2022 year, right? All of a sudden, the company started to report miss after miss after miss, quarter after quarter after quarter when it came to their EPS. And a lot of people started to distrust the stock on Wall Street, right? Because when you're known as the most well-run retailer and you're known as a company that comes in with beats every quarter, and then you come in with 3 consecutive big misses on EPS, everybody's like, what happened to you guys? What happened to you guys? Well, that's the past. Recently now, the company has started to come in with beat and beat and beat again and again and again as far as their EPS again. So the company clearly is getting back on the right track when it comes to their profitability, and that's a very, very exciting thing for me to see. I don't know if I could have, I don't think I could have really been a big buyer of Target stock last year, just given the fact that, you know, they were continually missing numbers, and it's hard to trust a management team that just misses numbers quarter in and quarter out. You got to kind of at least meet. But now, when I see this company beating and beating, and their stock price, you know, at, let's call it the lowest it's been in years, this is a pretty attractive time for me to be a buyer of the stock. I mean, to be honest, you have to go back to kind of around Rona time to find the stock trading this cheap in regards to Target overall, right? Now, in terms of the forward P, as far as this current year numbers, expected to be at about 16.6. Next year at about 14. I'll take that all day for a stock like Target. I believe, you know, the way I think about a stock like Target is, do I expect the stock to outperform or underperform the average stock in the S&P 500? I expect it to outperform when it comes to business metrics, right? And if I'm getting it for a cheaper valuation than S&P 500 trades out on average, then we're really, really talking, okay? Now, in regards to Target, the expectations for next year are on the floor. This is another beautiful thing. Analysts only have them on average growing 1% revenue next year. So, I mean, that's a pretty doomsday scenario considering the company's coming off of a bad 2023 for revenue side. So, imagine the company just grows 3%, 5%. You know, that's a pretty exciting situation when you're expected to grow 1%, right? And then what does that mean for EPS beats? Now, in terms of while I wait for the stock, I get to collect about a 3.5% dividend yield and payout ratio of a little over 50% on this one. So Target's one of these stocks again. I feel comfortable buying the stock in any sort of situation. A crash, great economy, okay economy. Give me Target shares for $120 something. I'll take them off your hands, okay? Anything under $150 really for me is a buy. Obviously, the closer we are to 100, the more aggressive, I guess you can say, I'll be a buyer of Target stock overall, okay? Now, number 6 of these 7 up here, and then we'll get into my hedge play, is Revolve, RVLV. This one might be a little more of a hidden stock for folks that some people might not know of or be aware of. But in regards to Revolve, they are a very successful e-commerce company in the fashion industry, clothing space, and specifically for millennials, like younger folks in general are huge. That's not their whole customer base, but under 40 is a huge component of their customer base overall. And they own Revolve and they own Forward. Forward caters much more to the very high end, which is a space that's been hit recently. If you look at some of the kind of the Louis Vuitton numbers, if you look at even like the Estee Lauder numbers, which is the highest end makeup company in the world, you know, those numbers have not been too exciting recently. And the same thing's kind of going on with Forward business here recently. Now, why is the stock being killed so bad? Okay, why is the stock gone from $80 to $14, right? The numbers, so net sales, obviously, the company was blasting off net sales, and then now recently net sales have fallen 6%. Gross margins have fallen about, let's call it 200 basis points roughly year over year. Net income fell 55%. The company is still profitable, but much less profitable than they were. Certainly a couple years ago when they blasted from $14 million of net income to $31 million of net income, right? To now be back down to 7 is just a huge disappointment. Adjusted EBITDA fell 61%. So all the numbers in the short term are pretty much bad. The only good number I can pretty much see is active customers up about 14% year over year. Total orders placed is, slightly growing, but considering your active customers grown 14%, that total orders placed is not an impressive number whatsoever, folks, okay? Now, if we look deeper in the business, the net sales, bad for Revolve, down 4% year over year. Forward, down 15% year over year. Revolve, as far as gross profit, down 7%. Forward, down 23%. The numbers are bad, just bad across the board, okay? And so that's how you get a stock price to go from 80-something dollars to $14 here today, folks. That's how it happens. Now, with that being said, I do not believe the reality of what is going on currently is going to be the long-term reality for Forward or for Revolve overall. Revolve has a phenomenal balance sheet, first and foremost, on this company, which I think the balance sheet gives you a good insight to how good a management team really is, okay? And in terms of Revolve, they built this balance sheet up tremendously over the years. $269 million of cash and cash equivalents now, as far as the latest quarter went. $629 million of total assets. That's versus total liabilities at $223 million. That's over $400 million in total stockholder equity. Very impressive. And if we think about this company over time, it has been an incredible growth company. I mean, these two gentlemen, the two co-CEOs of the company, right, have grown this company from a nothing company just 10 years ago to what it is today, right? The company even in 2017 did $400 million in revenue. This past year, they did $1.1 billion of revenue. I like a management team that not only has a proven business over time and is just going through tough times in the short term, but these gentlemen, I'm going to give them the benefit of the doubt. These guys have done tremendous over time. They've built this business up. I'm going to give them the benefit of the doubt. Not all management teams deserve benefit of the doubt. But for this management team and what they've been able to build over time, I'm going to give them the benefit of the doubt in this situation. And I believe brighter days are in Revolve's future in 2024 and beyond. But it's been a really rough patch here in the short term for the company. And I believe they'll turn things around in 2024. I believe profitability will come around. I believe margins will come around. And I think it'll be up and up from there. But nonetheless, folks, it's always a risk. And it's a risk I'm willing to take in regards to Revolve. Alrighty. Last one up here, and this is a potential hedge for me. This is in case the market gets bad, save myself on the other side and be able to flip puts into profits and put that money into long positions. And that one is Toll Brothers. So looking to potentially buy some put options that would expire either at the end of 2024 or beginning of 2025. Toll Brothers has been an incredible stock the past 5 years. The company's put up tremendous numbers, and their margins have been great. Profitability has been great. Revenues have been great. The backlog's been great. It has started to, their backlog has started to fall recently. But, I mean, the numbers have been pretty extraordinary for Toll Brothers for years now at this point in time, okay? But, with that being said, they're in a bit of a pickle, and this pickle could unwind in 2024, and that's not going to bode well for a stock that's at literally all-time highs in the history of the stock, okay? So, there's a lot of bad situations that can happen for Toll Brothers. One is rates go down. Now you might say, well, that would be good for a home builder like Toll Brothers. Rates go down. You could say that, but the problem is the main thing that's been benefiting Toll Brothers and all these home builders is the fact that inventory is on the floor right now. Inventory is about the lowest you've pretty much seen in many markets, certainly in decades, if not ever. It's incredible because most people are locked in at 2 and 3% mortgages, if not 4% mortgages, right? And with mortgages of 7% plus right now, they're just not even considering moving. So like, I don't want to list my house right now because, I don't want to move on my mortgage right now and then go from a 3% mortgage and buy something and then have a 7.5% mortgage or a 7.2% mortgage. People just don't want to do that. So if rates go down, inventory will loosen up, which would be bad for the home builders. If rates go up, then affordability goes down even more. Now, these home builders have been able to take this hit so far. I don't know how much more they can take the hit. Let's just put it that way. Everybody has their limits, okay? Now, there's another scenario where the economy gets bad, job losses start coming in 2024. If that happens, obviously home sales are going to go down. You can look back at past times. That's just what happens, right? And then lastly, the stock market's been tremendous in 2023. And that's great for Toll Brothers numbers currently because at the end of the day, Toll Brothers customers specifically pay very close attention to the stock market. These are higher net worth individuals. Toll Brothers' average home is somewhere around, let's say, $1 million or so they sell. So if the stock market goes down in any substantial way in 2024, for whatever reason, Toll Brothers customers will pull back. That's something we saw in 2022 when actually rates were even much lower than they are now. Toll Brothers customers started to pull back in a major, major way. Listen to the Toll Brothers conference calls in the third quarter and fourth quarter last year, in the fall quarter, in the summer quarter. It was depressing. And the reason being is a lot of Toll Brother customers saw the stock market just going down and down and down. Their portfolios start to go down, and they start saying, do I really want to go buy $1 million house right now, $2 million house? I think I'll wait on this right now. But with this year obviously being a great year for the stock market, obviously a lot of people's portfolios are feeling a lot better, and they're feeling more confident. And remember, going to buy a new home, especially in the $1 million bracket or above, it's a confidence play. That's what it is. It's a confidence play. And so with the stock market blasting higher, it's great for Toll Brothers. But if you do have, for whatever reason, a reverse of that, it's going to be very bad for Toll. That's why I look at it as a perfect hedge, because Toll stock always falls when the stock market falls in any substantial way. But on top of that, their customers pull back in a substantial way. That's why I look at it as just a amazing hedge for 2024, just in case the stuff goes bad. If it doesn't, that's perfectly fine, because that means my long positions will be printing money in regards to this one. And do keep in mind, Toll Brothers is a stock that's topped way before the economy was into recession in the past. If you look back prior to the great financial crisis, Toll Brothers stock topped in the summer of 2005. No one even got really concerned about the economy till 07, but it was really 08, and that's when everybody started to freak out. So just keep that in mind. Even if you feel like the economy is going to be fine for, let's say, the next 3 years, there's a high probability, or possibility, I should call it that, a possibility that Toll Brothers stock could top literally this year in 23. We'll see, okay? I just look at it as a very attractive hedge, and I hope it loses all its money if I, am going to do any hedges, because that'll mean likely my long positions did very well. I appreciate everybody joining me for this beast of a video. Thank you so much, folks. Oh, voila, I did it. I performed it. It's a beast video. Thanks so much for being here. If you want to support my content, do so on Patreon. That's pinned comment down there. I appreciate that in a huge way as well. Thanks for being subscribed, folks. Much love, and have a great day.